Welcome to The Explainer. Today, we're going to do an anatomy of a tech stock crash. The company in question? A Wall Street darling called Elastic. You've probably seen the ticker, ESTC. We're going to dig in and uncover some really timeless lessons here about risk. Lessons that every single investor needs to know.
It's the kind of question that'll keep you up at night, right? How does a company that has everything going for it, products people love, a fanatical user base, growth that's just off the charts, suddenly fall from grace? It feels like it shouldn't happen, but here's the thing we're going to see. Stocks that are priced for absolute perfection, well, they're often the most fragile ones out there.
Okay, so to really get the fall, you've got to understand the climb. We have to appreciate just how high this thing flew. Let's take a look at what made Elastic a must-own tech stock for so many people and figure out why exactly the market fell so head over heels in love with its story.
So what is Elastic anyway? Well, at its core, their products are pretty essential. I mean, they're the engine behind the search bar and apps you use every day, like Uber and Tinder. They also help companies keep an eye on all their digital infrastructure, and they even power huge cybersecurity systems. It's this incredibly powerful, super versatile set of tools that, you guessed it, businesses were lining up to pay for.
And of course, all that demand translated directly into just explosive growth. I mean, look at this. Year after year, the company was putting up revenue growth of over 40%. That's huge. It was all fueled by that massive shift to the cloud that was happening. And with numbers like these, well, the stock became an absolute high flyer, and its valuation just soared into the stratosphere.
But, even the fastest race car can crash if the conditions are right. And that's what was happening here. Just below the surface, this perfect storm was brewing. A mix of internal and external pressures was forming right on the horizon, and it was about to seriously challenge Elastic's flawless story.
The company was basically getting squeezed from two sides at once. On one hand, you had the whole market environment changing. Interest rates were going up, which made investors way less excited about paying a huge premium for growth way off in the future. Then, on the other hand, you had problems specific to the company itself popping up. Things like slowing sales and, a bunch of new competitors jumping into the ring. And that competitive pressure, man, it got intense, and it was coming from everywhere. Amazon Web Services, AWS, launched a direct clone that was cheaper. A company called Datadog started bundling similar services into a one-stop shop, making things tougher. And then you had the security giant Splunk moving aggressively right onto Elastic's home turf. You could just feel the walls closing in.
And this right here is the crucial point. The rules of the game just changed. Wall Street's big love affair with growth at all costs, yeah, that was over. All of a sudden, investors wanted to see a clear path to actually making money, to profitability. And that was a path that was getting a lot harder for Elastic to show. So, with the stage perfectly set, you've got a hostile market, you've got fierce competition, you've got sentiment completely shifting. All it took was one little trigger to unleash all of that selling pressure that had been quietly building up in the background. And when it happened, man, it happened fast. It was like a classic domino effect. First, a weak earnings report comes out, showing that growth is slowing down. That leads to a bunch of analyst downgrades, and that's followed by the company itself having to cut its own future forecasts. That was the final straw. The result? Just a devastating collapse. From its absolute peak, the stock lost 3/4 of its value. Think about that. 75% gone. Years of gains just wiped out in a matter of months. A lot of investors were left completely stunned.
And this wasn't just a simple case of panic selling. No, it was a structural chain reaction. The stock's ridiculously high valuation, it acted like rocket fuel for the crash. Once the big players, the hedge funds, the institutions, and their automated trading algorithms started selling, that downward momentum just became an avalanche, and there was no way for retail investors to get out of its path.
So after a crash this bad, the big question is always what happens next, right? Now look, nobody can predict the future with 100% certainty, but historical data from situations just like this gives us a really clear data-backed idea of what's probably coming.
What usually happens is the stock enters this long consolidation phase. It can last for months. It's basically the market just hitting the pause button. You've got all the shell-shocked sellers, and they finally meet a new wave of buyers who think, okay, the price is finally fair. And during this time, a new, much lower baseline for the stock gets established.
And if we look at the historical patterns from other tech companies after crashes just like this one, the data tells us that the most likely path forward isn't some quick V-shaped rebound. No, what's more likely is a period of just trading sideways for a while, before the stock actually moves down again to retest the absolute lows of the crash.
Okay, so how do we turn this pretty painful case study into something useful, something actionable? Let's build an investor's playbook. We can use the lessons from Elastic's story to help protect your own portfolio from something like this happening again.
All right, first up, you've got to watch the fundamentals like a hawk. Is revenue growth slowing down for, say, 2 or 3 quarters in a row? What about the net retention rate? Is that declining? That's a super important metric because it tells you if your existing customers are actually spending less. And finally, is the company burning through more cash instead of less? These are all major red flags.
Next, you've got to look at the price tag and who they're competing against. A stock trading at more than 10 times its annual sales without making any profit, that is a stock that's priced for absolute perfection. And as we just saw with Elastic, when new rivals start showing up, especially a behemoth cloud provider like AWS or Microsoft, that perfection is officially at risk.
And finally, believe it or not, the stock chart and just the general market chatter, they often tell the story before it ever hits the headlines. A stock breaking below its 200-day moving average? That's a classic warning sign. A whole wave of analyst downgrades? Another one. Or maybe you see an increase in selling by the company's own insiders and executives. You have to pay attention to these signals. And all of this, it brings us to the ultimate lesson from this whole story. Hype has an expiration date. It just does. An exciting story can carry a stock for a while, for sure, but in the long run, the underlying health, the actual profitability of the business, that's the only thing that really matters. And that leaves us with one final, maybe a little provocative thought for you. Take the checklists we just went through and apply them to the stocks you own right now. Because really, the whole point of this explainer wasn't just to figure out what happened to Elastic, it was to give you the tools to make sure it doesn't happen to you.